We've had a dramatic rally in markets since, in fact, most markets formed a base between the 18th of March and the 23rd of March. And since then, if we look at the Nikkei, the CSI or the Shanghai Composite, the Euro stocks, and the S&P, all markets are actually up close to 40%. So it's been a dramatic jump. Valuations in a number of sectors are now looking quite stretched. Now, I don't think that we're going to see a major reversal in equity markets. And the reason for that is primarily that bond yields and alternative asset returns, frankly, are pretty unattractive. And, we've still got 10-year bond yields at sort of minus 45 basis points. We've got the 10-year treasury anchored close to 60 basis points. So I think the first conclusion is, are we going to go into a major reversal? And the answer is no. But after the very major gains we have had, markets are obviously discounting a lot of good news. And I think, we can have a discussion about, the risks to that discounting of good news. And I would just highlight one risk, which the head of the Atlanta Fed talked about in a speech earlier this week, which is that whereas the late May and June data out of the United States showed a very strong V-shaped recovery, with all the bad news that we've now got on the US really struggling to curtail the coronavirus, there's a very high probability that July and August is actually going to see a setback for the US economy. And July data, not just the corporate earnings numbers for the second quarter, which we all know are going to be awful, but I think the economic data for July and August could see a setback for the US.
Bob, you talked about the markets as a whole, but I know that you believe there are subtleties in there in terms of rotation as well. And one stat that I've been pointing out to people today is while there is a buoyance in sectors such as tech in the US, which is up 18% year to date, actually energy is still down 43% year to date as well. So a 60% difference in the performance. Where do you see the rotation, Bob?
Well, on energy, I think, frankly, energy prices are stuck at the moment. We've got OPEC Plus, which has extended its cuts. We've got, if you look at the rig counts in the US shale industry, they are down dramatically. They're down sort of over 70% year on year. So I think we've got support for oil prices on that tightening in supply. We've also got some improvement in demand. Clearly, in contrast to the States, which I'm worried that the data could see a reversal in July and August, the data out of Europe and Asia on trend actually looks very good indeed. And I think if the July and August PMIs out of China should show the PMIs holding well above 50. So the demand side on energy has been improving. So I think after this big jump in WTI and Brent, and it's just extraordinary to think that, back in April, we had WTI at one stage at minus $40 per barrel. We're now at plus $38 per barrel. I think we're stuck, frankly, at the moment with this balance in demand and supply virtually, resulting in prices around $40 a barrel. So I think don't expect much volatility in energy sector at the moment.